Hello, good afternoon. Welcome to MF Corner on CNBC-TV18. I'm Vinnii Motiwala. Thank you so much for tuning in as always. Today, we are going to be putting the spotlight on new fund offers, NFOs. Now, obviously, we had seen that rush coming in 2024, where we had 239 NFOs that were launched in that year. Now, we're seeing a bit of a reduction coming in, but still, there are launches that come in terms of NFOs. Now, how should you, as an investor, choose the fund which is best suited for you? What are the risk appetite that you have? What are the factors that you should be continuing when you're looking at NFOs? To discuss all of this, today we have our guest joining in with us, Kirtan Shah, founder at Credence Wealth, to talk to us about all of this. Kirtan, good afternoon. Thank you so much for joining in with us as always. Kirtan, want to just start with, how should I evaluate NFOs? There's so much that's happening in the market as well. You already have mutual fund options. Why and when should one be looking at NFOs? What should be my checklist?
Vinnii, thank you so much for having me on the show. Vinnii, like you rightly put, I think there are more than 2,000 funds already available. And the NFO really needs to have something unique for you to really want to invest in it. Otherwise, there is absolutely no reason, in my opinion, for anybody who would want to look at investing in NFO. So a couple of things maybe here. Let's say, is there something new that the NFO is bringing on board which is not currently or existingly available? I think that is a point in time you probably might want to look at the NFO that has come out. Or there is something that this NFO brings on table, again, which is not existingly available, but it is solving a problem in the kind of portfolio that you are really willing to build. So why is this important? Is because you might come up with a new fund offer which is not available in the market at this point in time, but you should only invest in that fund if that fund is actually solving some problem with respect to the way you want to build the portfolio. Just because it is new and it's offering something that is not existingly available does not really mean for you to invest in it. And probably you might also look at some funds which there are fund managers that you've been tracking for a long time. They've got a great history in terms of performance, but for some reason, they've either moved to a new AMC or done something else, which is why they are coming out with new funds. Probably those are the kind of funds that you might want to look at. In my opinion, outside of these three reasons, there's really no fourth reason to look at investing in an NFO.
Right, absolutely. Because sometimes when I see these new NFO launches coming in as well, right, what is a unique feature that maybe you could give an example where you have seen some unique feature as well coming in versus the existing funds? Like sometimes you just have those Nifty 50 ETF NFO launches that are coming in. You have something that is already there, multi-asset, which is there. So why would I be looking at the fund? What is that difference then? And there's no comparison in terms of return that I have still, right? Other than maybe the fund manager, if I may know them. That is the only thing. So how and what is a differentiating factor or unique factor that you may have seen?
So like I said, Vinnii, you definitely don't want to invest in a Nifty 50 fund that has come out, or a smart beta fund that has come out, or an active fund that has come out, which is already existing in the market. If there is something new that comes out and it is able to solve a problem in your portfolio, you look at it. So to give you an example, let's say soon we will see a lot of SIFs, NFOs getting launched. Now that's a very unique product because the mutual fund industry has not offered anything like this in the past. It is probably the only product in the ecosystem that we deal with where you are going to be allowed to take 20-25% unhedged derivative positions. And I think that's very unique as a proposition. So when somebody comes out with an SIF as an NFO, then you don't look at it as an NFO. That is a product which is not available. But like I said, that does not mean that you would go ahead and invest in that. Only if you really have a need for something like that in your portfolio, you would want to look at an SIF in that context, even if it's an NFO, because it brings something unique that the industry does not currently offer. Or probably over the last 2-3 months, you would have seen a lot of NFOs coming out on income plus arbitrage kind of category. Now, this category did not really exist in the past, but because of the new tax regime and the way capital gains are taxed on the debt side, this is a new kind of product which is introduced, which will give you debt kind of a risk appetite, but equity kind of a taxation, right? Probably also there's been a lot of interest in silver over the last 6-8 months, and silver's not been, it's not a very popular mutual fund product that exists for a long time. So some of these offerings may look look interesting, but only if it solves some problem in your portfolio.
Absolutely looks interesting, but if they solve the problem in your portfolio, just something that I want to clarify on. So SIF is normally like, if you have 10 lakhs as an investment, that's the minimum investment that's required, right, for an SIF. So how will these funds also be working? So then I can go in for an SIP option for all this, or how would that work if that NFO comes out?
So the minimum that you have to invest, Vinnii, like you rightly said, is 10 lakh, and also that is per AMC. You cannot distribute 10 lakhs around 3 AMCs. You will have to put 10 lakhs in one particular AMC that you choose for. So let's say if that AMC comes out with 2 or 3 different categories of SIF, you only have those 2-3 SIFs categories in which you will have to deploy 10 lakhs. Okay. Now, what you have to understand is the minimum requirement is 10 lakhs. So if because of mark to market, if it falls from 10 lakhs to 9 lakhs, that's okay, right? But when you invest 10 lakhs, then you cannot go back to the AMC and say that I want to withdraw 1 lakh. Because once you withdraw 1 lakh, that will bring it down below the minimum threshold, which is 10 lakhs. So at 10 lakhs, if you want to withdraw, you will have to withdraw your entire amount. You can't withdraw 1 or 2 lakhs. Now, let's say after you've satisfied the minimum criteria, which is 10 lakhs, then you can do an SIP or an STP or an SWP, whatever you would want to do, provided you're able to make sure that the minimum required 10 lakhs is always maintained, except for M2M, because of which if it falls, it's okay.
Kirtan, what are the main risks that one should factor in while investing in an NFO? How do they normally differ from in terms of established mutual funds? What is it that an investor should look at?
See, ideally, the problem with NFO in that context are probably 2-3, right? First, because the grading of how much TER can the AMC charge you depends on the AUM of the fund. So higher the AUM of the fund, there is a grading system by which the TER or the charges automatically go down. Now, because this is an NFO and it does not have an AUM, so it has the flexibility to charge you the highest possible, right? So you will typically see that the total expense ratio in an NFO is very high. That's one problem. Second is you have no performance precedence, right? So if somebody is coming out with probably a small cap fund, you have at least 40-50 funds available in the market which 5-year, 10-year, 15-year of history, right? So that's another risk. And also because this fund has not actually existed, you don't really know if the fund manager is going to follow the objective of the fund. Now, what do I mean here is, let's say when the fund manager talks to the distributor or the investor community, the fund manager says that I'm a value investor and I will stand cash when markets look expensive. But when markets are expensive, they don't stand on cash. Now, you don't have a precedence to go back to. So this is another problem because you will never be able to understand whether the fund will stay to the objective that it originally started off with.
So then your point comes in, right, that the reputation of the fund manager, his track record, as well as the AMC's track record, I think that also will come into play, right, when you're evaluating to enter into a new fund offer.
Oh, 100%. I think like we just mentioned, right, there are more than 40 AMCs and continuously new AMCs coming up. Why would you want to work with somebody or invest in somebody's fund who's got a tainted reputation for whatever reason when you have so many other options available? And also, let's say, just to give you an example, let's say if you've seen an AMC offer a large cap, mid cap, small cap fund, you've seen the performance over a longer period of time. And now if they come out with a multi-cap fund, which invariably is going to invest in large, mid, small, and the fund managers are largely the same, it only gives you more confidence that this fund, though is an NFO, probably is not a new fund and it probably is going to draw the same strategy and the same fund managers do the same output, right? So both of these things definitely matter a lot in my opinion.
Kirtan, is there a time when you have ever looked at an NFO, maybe even though it may be a one that already exists, like maybe you see a multi-asset fund or an equity side, anything in terms of arbitrage active fund, have you ever seen that and said, oh, maybe this is interesting? Why is it interesting for someone versus an existing fund house? What was it that in terms of a differentiation that you may have found?
See, actually, like I said, there are 2-3 things that you will typically, want to look at. The first is, of course, if at all, like I gave you an example of a multi-cap fund, though it may look new, but it is invariably going to invest in large, mid, small only. And if they are going to be the same kind of fund managers, then I would want to look at it. Or let's say if I've been following a fund manager for a very long time, I'm very impressed with the kind of work that the fund manager has done. But the fund managers moved to a new AMC, and that new AMC is offering a new NFO. Then I would probably not look at it as a new NFO, because I know and I've seen the fund manager's performance in the past in some other product that the fund managers offered. Or let's say, for example, if you go 2-3 years back, multi-asset funds as a category was not very prominent, right? Now when something like a multi-asset fund is made available for the investor community to invest in, where it's the fund manager's discretion to move between a REIT or a fixed income or an equity or gold, I think that actually may be able to solve a lot of problems in a lot of investors' portfolio. And then you don't look at it as an NFO because it's a new category. You don't have a precedence. These are some cases where you definitely might want to look at those kind of funds.
Kirtan, anything, you have to give me some names now. Anything that you think that is there or in the recent months that you've seen that has piqued your interest in terms of an NFO?
I think 2-3 categories. So first, silver, because I don't think there are a lot of silver funds available. And this, for some reason, maybe a lot of commodity kind of exposure that you want in the portfolio is not currently available, because the only thing that you end up going to is gold at the end of the day. And because of the spiked interest in silver, and I'm not saying that you should invest in silver at this point in time, but I'm saying silver is an interesting thing that probably people can look at. And like I also made a mention, you have these debt plus arbitrage funds or income plus arbitrage funds that have come out. It actually can appeal to a lot of investors who are probably looking at, not a lot of volatility in the portfolio, but want to take advantage of equity taxation. So I think these are two categories that definitely, in my opinion, the investor community can look at. And probably the SIFs, once they get rolled up, will definitely pique a lot of interest, in my opinion.
Okay, thank you so much for that, Kirtan. Keep an eye out on all those updates. One is in terms of silver, SIF, and that comes in, as well as arbitrage in terms of the funds that are there recently launched. Maybe in terms of the taxation side, some bit of a benefit on that front is something that you all could watch out for. On that note, I beg your pardon, we're going to sip into a very short break. Don't go anywhere. We'll be back with more on the Mutual Fund Corner after this break. Welcome back to MF Corner on CNBC-TV18. Now we're going to shift our focus and talk about direct and regular mutual funds. So when you see a direct fund or regular mutual fund, why should you be investing in direct? Why should you be investing in a regular mutual fund? Which is a better one? What are the options that you have? What are the pros and cons of both these? And what will we see going forward in terms of a trend as well? In terms of returns for you as well, and what are the mistakes that you should be avoiding here? Kirtan is still with us to discuss all of this. Kirtan, let's start by talking about the main difference that you have between a direct mutual fund and a regular mutual fund. What is the difference that you are keeping an eye out on? And in terms of expense ratio that is there, that is a key one that I would know. And how does it impact in terms of a long-term return as well?
Vinnii, yes, the only or the largest difference between a direct and a regular is the total expense ratio, right? Which means that if I have to talk about equity as a case, typically regular mutual funds will have 1% moreover, so higher as a cost in terms versus the direct. And if you are looking at probably a debt fund, it might have cost impact of anywhere between 0.25 to 0.35. So when you take direct schemes, your cost is by that margin lower. Or the other way of looking at it is when you invest in regular funds, your cost is by that margin higher than the direct funds. Over a longer period of time, definitely it can end up making a lot of difference. To give you an example, because of trying to put this in context, let's say if you do a 10,000 rupee of SIP over 20 years, at 11%, you will be able to generate 81.5 lakhs. But at 12%, you will be able to generate 91.98 lakhs. So that 1% can make a difference of 10.5 lakhs on a 10,000 rupee of SIP spread over 20 years.
So regular is a bit more expensive by 1% if you're going in for the equity side. And for debt, it's around the percent that you mentioned, 0.25 and around that range. So that would, in the long-term story, make a very big difference that comes in. Kirtan, which type of investors should go in for a direct plan and who should actually go in for a regular plan or consider a regular plan instead?
See, I think in my opinion, the decision typically relies on two things. How much time do you really have, and how much understanding in terms of mutual fund investing do you have? So if I can give you three different examples, let's say example one, if you have time and if you have the understanding of investment, you might as well want to do direct and save on that cost that we spoke of. But let's say if you don't have the time, neither do you have the understanding, then regular is great for you, right? Because you will work with somebody who will help you in terms of investing. Now, the gray area here is, let's say you have the time, but you don't have the understanding, right? Then I would suggest that, it's probably a 50-50, but I would still suggest that you go for a regular. The reason why I make this comment is because, trying to save that 1% or a 0.5% make sometimes, and we've seen this in real life, that the investor community is not able to stay disciplined over a longer period of time, which when the advisor or the RIA comes on board, takes care of it, right? But again, the third case that I discussed with you is open for debate, but I would rather say that you take help of somebody so that you have the discipline and the portfolio construct works in your favor given your risk appetite and your goals.
Okay. Kirtan, while obviously your goals, risk appetite, all of that you explained as well, and why one should be selecting what plan according to the time period and the understanding they have in terms of holding it. What service or support do investors miss out when they're choosing a direct plan, right? Because that is also something that you get when you're choosing a regular plan. So what is it that they're missing out on in terms of selecting a direct plan?
So, Vinnii, when an investor typically opts for a regular plan, in my opinion, there are a lot of things that the advisor actually brings on board. So, to give you a couple of examples, I think typically when investors do direct, the way of selecting a particular fund for them is looking at the last 1 year, 3 year kind of returns, and whatever schemes have done well is the scheme that most in general people end up investing in. But when you get an advisor on board, ideally the advisor will look at your risk profile. The advisor will look at what goals do you really want to achieve, and then try and curate the right portfolio for you, right? So while you might say that I might just invest in a large cap ETF or a mid cap index fund, but how do you bring those 5 funds together is also in itself an art, because that will make sure that your risk is lower and the risk adjusted return that you generate on the portfolio becomes a little higher. So I think curating the right portfolio is a large advantage in my opinion. Also hand holding during volatile times. And I'm sure all of us have realized how, let's say from October 24 to March 25, when the markets were falling, how SIPs got stopped, how redemptions happened. Typically you need somebody to handhold you in such a situation and try and explain to you that, this is very normal of the market to fall, and that is no reason for them to really get out of investing. Another point that I really want to highlight is rebalancing. Rebalancing is extremely important over a longer period of time, which I believe that a lot of investors, when they choose direct, may not be able to do by themselves. And general operational help, comes as an advantage as well.
Absolutely. Rebalancing is a very important part in terms of your overall mutual fund strategy. But Kirtan, is there an option if I have picked out a regular plan or a direct plan and I want to switch to another one, vice versa, maybe you're from a regular to a direct or a direct to a regular, when should you be considering switching it one? And is there an option to do that easily?
Let me answer the second question first. Is there an option? There is definitely an option. So this typically works as if you are selling one fund and buying the other fund. Okay. So let's say if you are in regular and you want to move to direct, what you typically end up doing is you sell the regular fund and you end up buying the direct fund. Now, while you are trying to do this, there are two things that I would suggest in the hindsight for a lot of investors to take care of. That while you are trying to switch between a direct to a regular or regular to direct, there is definitely going to be a capital gains incidence, because like I said, it is like selling one fund and buying the other fund, right? And also there may be a case of exit load. So while you are trying to do this switch, make sure that you look at both of these things, exit load and capital gains. Now, when do you decide whether do you or should you move? I think the answer, in my opinion, is again very clear. If you have the time and if you have the understanding, right, then you might want to switch from a regular to a direct, right? Even if that comes at a cost of paying a little capital gains, because over a longer period of time, it might help. But let's say if you've been investing over the last 3, 4, 5 years and you've realized that, you probably might have the time but don't have the understanding, or you don't have either of them, then I would sincerely suggest that you get hold of somebody who can help you in the right direction and do the hand holding and move from direct to regular.
Okay. Kirtan, are there any specific risks or common mistakes investors normally make, or you've seen them make, or when they come to you and ask for advice in terms of while picking up these plans as well? A typical one which they make.
Yeah, I think a couple of typical mistakes that I always see the investor community end up doing. The first and the most important one is the selection of the scheme. So, unfortunately, what happens, and I did make a mention of it in one of your last questions, that the problem is that the selection process out of the 2,000 odd schemes available in the market is only looking at the returns. So the community looks at the 1 year, 3 year, 5 year, 7 year, 10 year kind of returns, and then decides that, this particular fund has done really well. Let me invest in this particular fund, right? So the choice of selecting the fund is typically the 1 year, 2, 3 years kind of return, and that's one of the biggest mistakes. And I would really want to say this, that if you look at the last 3 years of return and enter into a fund, 9 out of 10 times you are up for a bad surprise, because in the coming 2, 3 years, this fund will underperform because of the styles of the fund management and the market, right? What do I mean? If you look at the last 12, 18 months, you will typically see a lot of funds who follow the value style of investing they have ended up doing very well, because the market favored value style of investing. But now looking at this, if you enter into that fund, probably the fund might not be able to continue the same kind of performance that it showed. So if you look at the last 1 year, 3 year return and buy into a fund, that's the first mistake that I see most investors do. Second also is curation of funds, in my opinion, Vinnii, because, it's not as simple as saying that, I will end up buying a flexi cap fund and let the fund manager do whatever he wants to do. Because while you are trying to curate a portfolio, at least in my opinion and the way I look at it, you need a market cap level diversification. You need a diversification at the AMC level, and you also need diversification at the style level. So while you are trying to build a 4-5 fund portfolio, you want to make sure that, some money is allocated to large, some is allocated to mid, some is allocated to small. And also you have growth, value, momentum, all three styles of investing which you are investing in, so that it's well diversified.
Okay. A quick one, Kirtan. I just want to know that, is there a percent that maybe I should hold as a direct or indirect? Does that matter as well, or regular as well?
Not really. I think, but if I still have to answer that question, I would rather say that whatever large cap allocation that you want to put to your portfolio, you might want to look at doing a Nifty 500, a Nifty 50 or a Sensex fund, right? But on a mid cap, small cap, you probably might want to get active funds, and that can be a great combination of fund that you would want to hold.
Okay, Kirtan, thank you so much for that. And thank you so much for joining in with us as always and helping our viewers understand concepts in the mutual fund world and mutual fund corner. So thank you so much for joining in with us. And viewers, thank you so much for tuning in. Up next, we have Closing Bell, so don't go anywhere.